On April 7th at 5:32 p.m., Donald Trump announced a ceasefire with Iran. And from this announcement, we learned two things. First, Truth Social is the single greatest invention of our generation and is totally not a useless social media platform. And second, markets don't like uncertainty, because the very next day after the announcement, the markets ripped. The S&P closed up 2.5%, the Nasdaq almost 3%, and the Dow climbed more than 1,300 points, which marked its best day in almost a year. But it didn't just stop there, because a few weeks later, stocks were back at record highs, even as the ceasefire was actively falling apart in real time. Traditional financial media was calling this a relief rally, that the markets were celebrating peace, but the truth is, that's not what this was. This was something else entirely. But to understand what actually happened, why markets can be at all-time highs when there's a war going on, you first need to understand what Wall Street looked like going into this, because there's a lot more to this story than just a relief rally. On February 28th, the US and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was killed. Then Iran shut down the Strait of Hormuz, and the market had its worst 5-week losing streak in nearly 4 years. The S&P was down nearly 9% by the end of March. And while your retirement account was quietly screaming, there was something else happening underneath the surface. Wall Street was beginning to panic. Hedge funds didn't just start repositioning. They were selling at the fastest pace in 13 years. And that's not a loose estimate. That's hard data, because Goldman Sachs had a front row seat to the show. They run what's called a prime brokerage desk, which services most of the major hedge funds on Wall Street, which means they see what these hedge funds are buying, what they're selling, and just how leveraged they are. And according to Goldman's own numbers, Q1 hedge fund selling in North America was the largest since April 2020. Gross leverage was sitting over 300%, near an all-time high. And short exposure to macro ETFs like SPY and QQQ hit the highest level since the pandemic. And then on March 19th, commodity analyst Rory Johnston said this.
If you think about some kind of massive detonation in the oil market supply chain in the Middle East, and there's this shockwave that's kind of moving out, this shock is too large for the system to handle, and it will begin to creak and break the longer this goes on.
Just how many barrels per day were those disruptions, the squeeze of 2008, and how big is this in comparison?
It's bigger than anything in history. Every analyst I speak with, people again that are, I respect people that are not alarmists, people that make fun of the alarmists. They're all terrified to say, the East-West pipeline is maxed, there's no issues at Yanbu, the Houthis don't get involved, etc., etc. In that scenario, with the strait remaining closed, we still need to shed 15 million barrels a day of global demand. And that just means prices, $250, $300 a barrel Brent. We will hit all-time highs in that scenario, on an inflation-adjusted basis. Almost guaranteed. Almost by necessity. So I do think in that scenario, again, recession is too light a term. We're talking depressionary.
Fast forward 6 weeks later, and this might be the funniest take of the year. We'll come back to why in a second. But at this point, the sentiment on the street was pretty clear. Everyone was bearish. Then, on the evening of April 7th, Trump announced the ceasefire. And when the markets opened the next morning, it was like someone turned Jerome Powell's money printer back on. Because over 400 names in the S&P finished green, 13 stocks printed all-time highs, Brent crude dropped around 13.5%, and WTI crude fell over 16%, marking the biggest single-day decline since April 2020. But here's where the mainstream explanation for all of this starts to break. According to maritime intelligence firm Windward, who utilizes AI to cross-reference digital GPS signals with satellite radar and imagery, only 5 outbound carriers were actually detected moving through the strait by midday. This is a roughly 96% decrease in activity compared to the pre-war baseline of around 130 daily transits through the Strait of Hormuz. So something's not adding up. How can there be a relief rally based on world peace, if there's actually no world peace? Which raises the question, what really moved the markets? And the answer is, a good old-fashioned short squeeze, and I can prove it. But for this to make sense, we first need to explain the underlying mechanics of a short squeeze. Because when you short a stock, you're borrowing shares from someone and selling them. You're betting the price drops so you can buy them back cheaper at a later date, return them, and profit the spread. But if the price goes up instead, you're f***ed because you still have to return those shares you borrowed, which means you have to buy them back at a higher price than you sold them at. And if the price keeps rising, your losses keep growing. And at some point, your broker may send you a margin call, which means you either add more money to your account or you close the position immediately. And when enough people get margin calls at the same time, they all have to buy back their shares. That buying pushes the price up, which triggers more margin calls, which triggers more buying, and that's a short squeeze. And on April 8th, when the macro short exposure was at the highest level since 2020, the squeeze began. But the squeeze was only the first domino to fall, because once stocks started ripping, the algorithms kicked in. And this is where the CTAs, or commodity trading advisors, enter the story.
Oh no!
Oh no!
Oh no!
Oh no!
Oh no! Oh yeah!